I recently received an email teaser from Morningstar, an investment research organisation, inviting me to subscribe to their Morningstar investor service. The email subject header was, and I quote, "Markets with 13 plus per annum expected nominal returns over the next 10 years. Then came the body of the email as follows. Which international markets can you look to for more favourable long-term returns? Morningstar Investment Management have released their latest expected 10-year returns for various emerging and advantaged markets, as revealed in the chart now shown on the screen. The email continues. As you can see, emerging markets, Brazil and China, top the list with 13.85% and 13.13% expected 10-year nominal annual returns respectively. The email then offers access to Morningstar's 5-star rated Brazil and China shares inside the Morningstar Investor Service for a 4-week trial. They go on to further pique the reader's interest with the claim that active managers have traditionally done well in emerging markets because of inefficiencies in the underlying market. It's easier to find undervalued opportunities in these markets and beat their passive rivals. Now, Morningstar is an organisation of substance and surely will be able to back up its claims. But returns of more than 13% per annum for the next 10 years and knowing which particular shares to buy to perhaps do better than that sound like offers too good to be true. And they almost certainly are. Although I didn't take up the offer of a 4-week trial, I expect the apparently confident statements made in the email will be watered down considerably when the detailed rationale for the forecasts and share selections are examined and the inevitable disclaimers taken into account. The FinHealth approach to personal finance, and the subject of this video blog, relies on research in 2 major areas of investment theory to never be seduced by any investment experts, such as Morningstar, regardless of their perceived substance. Any institution or individual that claims that they both know 1, what share market returns are going to do over the next 10 years, or even the next week, and 2, which shares will outperform their relevant share market over any period of time, and 3, are willing to tell you for a modest fee, should be treated with loads of scepticism. It simply defies both the best academic research and common sense. But putting the findings of the investment theory and research into practice requires letting go of the spurious notion of maximising your investment wealth. However, when combined with other elements of FinHealth's approach to good financial health, that is, tax effectiveness, asset allocation and diversification, they offer the possibility of a good investment experience without the angst of choosing which expert to align with or trying to pick investment winners yourself. Hi, I'm John Lesky, retired personal financial advisor and founder of FinHealth, a tool to guide you to your financial independence. Both areas of investment theory to be discussed are associated with Professor Eugene Farmer, a financial economist from the University of Chicago, who shared the Nobel Prize in Economic Sciences in 2013 for his groundbreaking work in financial economics. The first proposition we'll consider is what is called the efficient market hypothesis. It essentially claims that share market prices at any point in time reflect all available information. They are the consensus view of all market participants. Now, the efficient market hypothesis can't be directly proved, but If a reasonable description of reality, share prices will only change in response to new information, which by definition is unknown. Ahead of receipt of such information, it's impossible to say whether its effect on prices will be positive or negative. If you accept the view that share and other asset markets are informationally efficient as a working proposition, key implications that are critical for investment practice and have been supported by academic study after study include 1. Simple share trading rules don't reliably work. 2. Fundamental analysis to identify over or undervalued shares is not a worthwhile endeavour. And 3. New information is incorporated into asset prices almost immediately, so there's no benefit to be had from trading on yesterday's announcements. The theory is bad news for active fund managers that want you to believe they are smarter than the market and can reliably pick winners. But the evidence indicates that, on average, their performance doesn't justify their premium fees. However, it's good news for individual investors who may be concerned that they are at a disadvantage to investment professionals and need to pay for the advice of investment experts. Market efficiency means that at any point in time, they can rely on the current price of a financial asset as the relevant market's best assessment of value. Practical implementation of this view of markets, it's largely responsible for the explosive growth of passively managed, low-cost index funds in developed share markets over the past 40 to 50 years. The second area of groundbreaking research, conducted by Pharma, in collaboration with Professor Kenneth French of Dartmouth College, delves deeply into the idea that you can't expect to receive higher expected investment returns without taking additional risk. They set out to explain the specific factors that drove higher expected share returns, both in their domestic US market and internationally. It had long been recognised that there was an expected, but not guaranteed, premium for investing in the share market rather than cash because of the greater risk. However, Pharma French's initial research in the early 1990s revealed an additional expected premium over that provided by the share market for investing in small shares compared with large shares and value shares compared with growth shares. Pharma French claim these size and value premiums are compensation for additional levels of risk above that already inherent in the total share market. They subsequently expanded their three-factor model, that is, the total share market, size and value, to a five-factor model, adding two additional risk factors suggested by both investment theory and detailed research. They are 1. Profitability, that is, the operating profitability of a share's underlying company. Shares of profitable companies tend to perform better. And 2. Investment, that is, the total asset growth of a share's underlying company. Shares of companies with growing assets do worse. The inclusion of these two factors in the model reduced the significance of the value factor, in particular, as a driver of expected returns. The model is now the benchmark for examining fund manager performance. If an equity fund manager has outperformed the market, it enables an assessment to be made regarding whether the outperformance is due to skill, luck, or more often than not, an unwitting tilt to one or a combination of the risk factors. The five-factor approach allows investors seeking higher returns to take additional risk in a manner that the research suggests is most likely to achieve increased returns. By implication, investment approaches that offer additional return without resorting to these risk factors are almost certainly unsubstantiated and/or taking more risks than necessary to achieve the desired return. For example, Morningstar's insinuation in the email they sent to me that expected international share market returns are driven by geography, that is Brazil and China, or sector, for example, Australian consumer staples or financials, isn't supported by the most rigorous academic theory and research. So, what are the conclusions for investment practice from the most rigorous assessment of the available evidence? It indicates that, for most people, they'd be better off, 1, not trying to outperform the total share market, that is the efficient market point of view, and 2, if they need or want higher expected returns than offered by the overall share market, only taking risks that research has shown to be reliably rewarded in the past and theory suggests will be rewarded in the future. That is, applying the 5-factor model. The highly competitive nature of financial markets and other transparent, well-informed markets means there isn't any easy money to be had, even by the most diligent of investors. On the other hand, it also means the returns of financial markets are there for the taking, for the patient, disciplined investor that's prepared to accept that you don't need to be smarter than the market to have a good investment experience. Hopefully you found this video of interest. I'd like to know what you think. Please provide any comments or questions below. Finally,